Welcome back to Investing Talk Podcast.
Today we're looking at BitMine Immersion Technologies, and this is a really fascinating one because it's not just a mining company. It is essentially an Ethereum treasury powerhouse. They are holding nearly 4% of the entire global supply, and the kicker is that it's currently trading at a massive discount to its own assets.
As usual, before we start, subscribe, like, and comment to this video to support the show. We always appreciate it. But, okay, so you're calling this a treasury powerhouse.
Yeah, absolutely.
But I'm looking at the setup here, and we've got a company with what you're calling a flawless balance sheet, but they are posting massive, just absolutely massive losses. I'm already pretty skeptical about how those two things can exist at the same time.
I know, it sounds like a total contradiction, right?
Yeah.
I mean, how can you be bleeding money but have a pristine balance sheet? But that's exactly why we need to unpack this. On paper, it looks rough, but if you dig into the actual structure of the assets, it's a completely different story.
Well, let's get into it then. Walk me through the numbers.
Okay, so let's start with the top line, because the forecast revenue growth is wild. Analysts are projecting 93.1% per year.
Wow.
Yeah, nearly doubling every single year. And that's being driven by two main things. First, the sheer expansion of their Ethereum holdings, which we'll get into, and second, their ETH staking initiatives.
So for anyone who isn't deep into the crypto weeds, staking is basically just locking up your crypto to help validate network transactions, right?
Exactly. You lock it up, and the network pays you a yield. It's essentially like earning interest on a savings account, but paid out in more Ethereum. So they aren't just holding the asset is actively generating more of itself.
Right, which sounds great. But let me jump in here with the ugly numbers because we can't ignore this. The reported ongoing losses are sitting at $4,872 million US.
A huge number, yeah.
That's almost $5 billion in losses. And if you look at the return on equity over the past 5 years, it's negative 43.15%. And the current PE ratio is negative 1,033.9.
I know. It looks terrifying on a traditional stock screener.
I mean, negative 1,000 PE, that makes me seriously question their profit margins, especially with all this crypto exposure. Like, are they running a real business, or is this just an incredibly expensive way to gamble on Ethereum?
That's the exact question the market is asking. But you have to understand how GAAP accounting works with crypto. Those aren't necessarily cash losses. A huge chunk of that $5 billion is from impairment charges.
Okay, break that down for me.
So under the rules, if the price of Ethereum drops below what they acquired it for, they have to write down the value on their balance sheet and report it as a loss, even if they haven't sold a single token.
So it's a paper loss.
Exactly. During the crypto winter, the price tanked, so they had to report billions in losses. But they still hold the exact same number of tokens. The coins didn't vanish. And here's where the moat comes in and why I called the balance sheet flawless.
Go ahead.
They have zero debt. BitMine is confirmed as one of the best debt-free mid-cap stocks out there right now. Seriously, zero debt, while eating $5 billion in paper losses.
Zero debt. And look at what they actually hold. Their total holdings, so that's combined cryptocurrency, cash, and investments, sit at $10 billion.
$10 billion, that's massive.
Right. And to be really specific, as of February 9, 2026, they hold 4,325,738 Ethereum tokens.
That's incredibly precise.
Well, the blockchain is public, so we know exactly what's in the wallet. That specific stash is valued at roughly $9.2 billion. That means they control 3.62% of the total global ETH supply.
Okay, almost 4% of all the Ethereum in the world. That's not just a company, that's a whale.
They're practically their own central bank at this point, and that's why you can't just look at the paper losses. They have an unparalleled asset base.
But what about the actual operations? Because they are called BitMine Immersion Technologies. They do actually run data centers, right?
Yes, and that's the infrastructure side. They use proprietary thermodynamic management in their data centers. Thermodynamic management. That sounds like a fancy way of saying they run air conditioners.
Actually, it's the opposite of air conditioning. They don't use fans. Immersion technology means they literally submerge the servers into a specially engineered, non-conductive liquid coolant.
So the computers are just sitting in a bath of liquid.
Yep. It sounds crazy, but it pulls heat away from the chips way more efficiently than air ever could. And why that matters for the business is that it creates incredibly high switching costs for their clients.
How so?
If you're a crypto miner and you set up your rigs to run in BitMine's immersion tanks, you can't just unplug and move to a cheap warehouse down the street. Your hardware is optimized for their liquid environment. It makes the clients extremely sticky.
Okay, I see. So there is a real physical business moat there alongside the crypto holdings. But you mentioned a valuation discrepancy earlier.
I did. This is the craziest part. Their price-to-book ratio is currently 0.8x.
Wait, point 0.8. So the stock is trading for less than the literal value of the assets on the books.
Exactly. You are buying $1 of assets for 80 cents. Meanwhile, the peer average in this sector is 12.3x.
That is a staggering gap.
It is. The stock is deeply undervalued relative to the literal, liquid assets they hold. And management knows it too. Just recently, they purchased another 45,759 ETH for $90 million.
So they aren't selling to cover costs. They're actually buying more.
Doubling down. They aren't diluting the stock to survive, they're aggressively adding to the treasury.
Let's pivot to the charts and see if the price action matches the story. Because buying $1 for 80 cents sounds great, but sometimes things are cheap for a reason.
Let's look at the tape. Currently, it's trading at $20.13.
Okay, and I see the analyst target here is $43. So Wall Street is implying a pretty massive upside there, over 100%.
Right, and the momentum is already building. The 30-day return is 30.1%. Year-to-date, it's up 35.46%.
And taking the long view, the one-year total shareholder return is 211.67%. So if you got in a year ago, you're doing incredibly well.
You're thrilled, yeah.
But I have to point out the recent pullbacks. I'm looking at the chart, and we saw some breakdowns below that $15 support level recently. It's been testing those supports pretty hard, mostly tracking along with general weakness in Ethereum.
Oh, absolutely. The correlation is very tight.
Right. If ETH drops a few percent, BitMine seems to magnify that move.
It acts like a leveraged proxy.
Right.
But if you look at the Benzinga Edge momentum score, it actually surged week on week from 88.65 up to 94.23.
That's a strong momentum indicator.
Extremely strong. It's flashing a potential rebound signal as people start to realize the crypto winter is effectively over.
What about the volume, though? Is it just retail traders pushing this around, or are we seeing actual institutional flow? Because usually these high volatility crypto plays are entirely retail driven.
That's what you'd expect, but the volume analysis tells a different story. Even during that price pressure you mentioned, the volume showed heavy accumulation. Big buyers were stepping in.
Now, let's look at what the street and the big money are actually doing. Because if volume is showing accumulation, somebody with deep pockets is buying the dip.
The quantitative sentiment right now is overwhelmingly bullish. You've got top stories everywhere, like Tom Lee calling it his $200 million moonshot bet.
Tom Lee is always swinging for the fences, though.
True, but the media is calling it a hedge fund favorite. And the institutional moves back that up. Look at Bank of America.
Bank of America.
Really? Yes, they just hiked their stake by a massive 1,668%.
That is absurd. A legacy bank increasing their position by over 1,600% in a crypto stock.
It's totally real, and it's not just them. Morgan Stanley, Goldman Sachs, BlackRock, ARK Invest, they are all actively increasing their stakes.
I can understand ARK, but Goldman and Morgan Stanley. Why are the smartest guys in the room loading up on a company with a negative 1,000 PE?
Because smart money clusters around unique opportunities. They see the debt-free balance sheet. They see the 0.8x price to book. It's essentially a clean, publicly traded wrapper for Ethereum.
A wrapper.
Right, because a lot of these big institutional funds have strict compliance mandates. They can't just go open a digital wallet and hold billions in raw crypto.
Exactly. The regulatory hurdles for direct custody are a nightmare for traditional banks. But buying equity in a publicly listed tech company, they do that every single day.
So they use BitMine as a backdoor to get Ethereum exposure without triggering compliance alarms.
That's the thesis. And there are massive catalysts coming. Tom Lee is forecasting the definitive end of the crypto winter by this month, February 2026.
Which would obviously lift all boats in the crypto space.
Right. And if Ethereum rebounds and hold above $2,000, you're going to see chatter about potential M&A or huge expansions to their staking operations. The operational leverage here is incredible if ETH runs. Hold on, we have to look at the risks before getting too excited. It's easy to look at the upside, but there are some serious red flags here.
Let's hear them.
First and foremost is the extreme crypto volatility. The primary risk is the underlying asset itself. If Ethereum crashes, and let's not forget Peter Schiff is out there warning that Bitcoin could still plunge back to 20K if that happens, Ethereum will drag down with it.
Oh, it would be a bloodbath, no question.
Right, that $8.7 to $10 billion holdings value could evaporate in a matter of weeks. The stock is tightly correlated to ETH, so if crypto dumps, this stock doesn't just drop, it craters.
It's an undeniable risk. You're totally exposed to the macro crypto cycle.
And then there's the execution risk. We talked about the immersion cooling in the data centers, but the operational side is still bleeding money. We're talking $4.8 billion in reported losses.
A lot of that is paper losses, like we discussed.
A lot of it, yes, but not all of it. Running data centers isn't free. Can they actually turn a profit on the operations, or is the business just a very expensive proxy for holding Ethereum? If the mining and hosting don't become profitable, they're just burning cash.
That's fair. They have to prove that the thermodynamic tech actually yields superior margins over time.
Exactly. And finally, there's what I call the discount trap. You mentioned it trades at 0.8 times book value.
Yeah.
Well, sometimes the market is right. Sometimes a discount is there for a reason. The market might be actively pricing in the risk that those crypto assets could devalue, or that management might misallocate the treasury. Just because it's trading below book doesn't automatically mean it's a steal.
So weighing the massive treasury against the operational losses, what's the call?
I mean, you've got the research in front of you. Where are you landing on this?
I'm giving it a bullish score of 8 out of 10.
An 8 out of 10, even with all those execution risks and the volatility.
Yes, and the thesis really centers on that strong treasury mode.
Yeah.
Holding around 4% of the global Ethereum supply is a structural advantage that cannot be easily replicated. No competitor can just spin up and acquire that kind of market share without rocketing the price.
True, the barrier to entry there is massive.
Yeah. Then you add in the institutional flow. When you see Bank of America and BlackRock doing massive buying, it outweighs the fear of near-term volatility for me. The big money is positioning for the long game.
And they have the capital to wait out any remaining crypto winter.
Exactly. Plus, you've got the 93.1% revenue forecast. The target horizon here isn't a quick flip. This is a multi-year hold into the peak of the next ETH cycle.
So what's the ultimate takeaway for someone looking at this stock?
The elevator pitch is simple. This is a completely debt-free way to buy Ethereum at a steep discount with a built-in operational upside.
You're getting the crypto for cheap, and the data center business is essentially thrown in for free.
Right. It's a high beta play, but the underlying asset value provides a fascinating safety net.
Well, here's a final provocative thought for you to mull over. We talk about how institutions are using this stock as a proxy because they can't easily buy ETH directly due to compliance. What happens when the regulations finally catch up? If the SEC and the banking regulators create a clear framework, and those institutions can suddenly just buy Ethereum directly, does the premium on this proxy trade completely evaporate? It's definitely something to watch.
That is a very valid point to keep an eye on.
That's it for today. Don't forget to subscribe, like, and comment to this video to support the show. See you next time.